Nervousness on Wall Street, stocks selling off yesterday as investors reprice equities ahead of the Fed's transition from easy money policies to tightening policies. There's also, of course, questions about the impact of Omicron and inflation on earnings. I interviewed JPMorgan Chairman and CEO Jamie Dimon in the middle of all the volatility yesterday and got his views on the backdrop and what's ahead for the year.
I think the way to really look at it is, first of all, look at the economy and then the markets. The economy, the consumer's in great shape. Obviously, there's some folks still suffering out there, but they've got a lot of money. They're spending 25% more than they did pre-COVID. Their balance sheet's in great shape. The debt service ratio's better than it's been in 50 years, literally. Home prices are up, stock prices are up. Businesses equally are doing quite well. They got plenty of money and plenty of confidence. So that economy's growing. The numbers are herky-jerky because coming out of the pandemic, it just caused a lot of uncertainty about people rejoining the workforce, the return to the office and inflation numbers and all that, but the economy is strong. I think the expectation should be we need a strong economy to justify asset prices. And obviously, when interest rates go up, people are going to reprice assets a little bit. So I just would expect that you're going to have a lot of volatility in the market this year, but you're going to probably have a pretty strong economy, which is maybe more important for most Americans.
Yeah, I'm glad you mentioned the macro story because you have an incredible vantage point on the consumer, looking at your credit card statistics. I want to get into that. But we saw 199,000 jobs created in the month of December. That was about half of what people were expecting. The conversation is about inflation right now. The Federal Reserve expected to raise interest rates. How do you assess the economy playing out in 2022 and beyond, given all of that?
I think people are over-focused on monthly numbers, which are distorted by a million different things, and that I think that the table is set for a very strong economy. That consumer has a lot of money and business has a lot of money. They're spending it. Confidence levels are going up. Jobs are plentiful. Wages are going up. I mean, it's pretty strong. This will be one of the strongest economies we've ever seen in 2021, and 2022 will probably be pretty good too. And obviously, the fly in the ointment is inflation, and no one knows exactly how it's going to turn out. I've always thought it wasn't just transitory, or at least people wouldn't feel it was transitory by the end of the year. And, some people think it's embedded in the market. It's going to go down to 2.3% by the end of the year. I think it'll be a little bit higher. But, look, if we're lucky, the Fed will engineer that so-called soft landing and raise rates, facing a strong economy and employment coming down. There's always a chance they're going to do it faster than people think. And we just don't exactly know. I mean, no one knows the future. And, if you look at anyone's forecast, I mean, they almost never get the inflection points right. So, but I also go back and you look at in March of 2020, we were on our way to 15% unemployment. It could have been 20% unemployment. COVID was killing a lot of people. You remember being in New York City, how terrible it was, and we didn't have a vaccine. So let's count our blessings still, and we're still getting through this thing, and hopefully Omicron may. We don't know about the future variants either, but hopefully Omicron may be the final one that makes this endemic.
Yeah, there's certainly some expectation in that regard. But back in 2007, we were also looking at an uncertain market. You saw the crisis coming before many, and you started reducing areas with the most risk. Tell me about the risk around the Federal Reserve, going from an easing environment to a tightening environment. I mean, look, JPM and so many other financials benefited greatly from all of this liquidity. Do you see this as this liquidity about to go away? I mean, what happens now when the Fed raises rates and begins this balance sheet runoff?
Yeah, so it's very, very different in 07. In 07, the world was massively over-leveraged. Hedge funds, private equity, syndicated loans, some of the banks and investment banks, CIVs, banks globally. This is completely different. The world is not over-leveraged. You could say the government is, but the government has a whole set of different powers than the individual companies do, and consumers were over-leveraged back then. Today, now they're under-leveraged, so it's wholly different. So, and I also think liquidity had pluses and minuses for everybody. I mean, keeping rates low is terrible for banks. The recovery was obviously very good for banks and all of that, and very good for everybody. So, there was $12 trillion of global liquidity, some of which can have to be removed. No one should be surprised the rate's going to go up and that kind of monetary and fiscal stimulus, which is extraordinary, multiples of what the world's almost ever seen before. And it's going to be hard to figure out what it means when it gets removed. But in the meantime, jobs are plentiful, wages are going up, companies are healthy, consumers are healthy, and the market's going to be volatile because they're trying to figure out exactly what you're asking me. And you know what? They're not going to be able
Yeah.
to figure it out. You're just going to have to live through it.
I was reading somewhere earlier that the stimulus was 25% of GDP. Jamie, how many rate hikes are you expecting?
I don't know. I rely on my economists. They're very, very smart, and they would probably say 3 or 4 this year. I would probably say a little bit more. Maria, I also want to put in perspective. Paul Volcker raised rates effectively 200 basis points on a Saturday. To raise it 25 basis points, if it goes up 1% this year, I don't think that in and of itself has enormous economic effect. I think that all the borrowers that completely easy can handle that, particularly if you have a strong economy. So you can go to almost any company, higher sales is more important than slightly higher interest rates. And that's true for most things. And, housing, would be slowed down just a little bit by that, but housing is booming. So, hopefully the Fed can navigate these things, but you're going to have to deal with higher rates. And people just get their heads wrapped around that. And by the way, they've been artificially low for years. I mean, even just a normal would be 3.5% in the 10-year bond and 2% in Fed funds. Just a normal thing. And, that we're going to return to normality one day.
Yeah, that makes sense. Jamie, let's talk JPM for a moment. You had another great year last year. The investment bank on fire with all of the M&A, SPACs, all of the trading profits. But over the last year, we were questioning loan growth. It was not where many expected it to be. Go through the consumer and the commercial business, and how does loan growth look, and what do you expect for 2022?
Yeah, so I'm the opposite of it. I don't think loan growth by itself is a good thing. Loan growth is an outcome of decisions you make. But let me just separate the consumer from companies for a second. On the consumer side, there was plenty of loan growth in mortgages and a lot of payoffs in credit card. But that was because individuals were strong. Usually when loan growth goes down or negative, that's because people are over-leveraged. It's the opposite here. Loan growth was low because people had a lot of money and were able to pay off some of their, I think it was $150 billion of credit card debt, et cetera. And then also a lot of the loan growth on the mortgage side was refinancing, which is actually better for customers. On the business side, it's completely based upon their needs, and their needs are based upon growth. And think of inventories, receivable, CapEx. And so as we return to normal growth, their needs are starting to go up. And so you're going to see banks reporting loan growth numbers, and they're going to be better now than they were a quarter ago. But that's the outcome of a growing economy. And so you may very well, if I am right, you have good growth next year. Loan growth in the business side will probably return to normal. On the consumer side, it will return to normal. It just may take another 6 to 9 months.